Hello everyone, I am Reena Catherine, Assistant Professor in Department of Commerce. I am working in Dr. SNS Rajalakshmi College of Arts and Science. Today we are going to see about what is capital market. A market including all institutions, organizations, and instruments providing medium and long term funds is known as capital market. A capital market does not include institutions and instruments providing finance for a short term, that is up to 1 year. Some of the common instruments of a capital market are debentures, shares, bonds, public deposits, mutual funds, etc. An ideal capital market is one that allocates capital productively, provides sufficient information to the investors, facilitates economic growth, where finance is available to the traders at a reasonable cost, and where market operations are fair, free, competitive, and transparent. Next, classification of capital market. A capital market is of two types, that is primary market and secondary market. Let's know about what is primary market. Primary market is a market in which the securities are sold for the first time is known as primary market. It means that under the primary market, new securities are issued from the company. Another name for the primary market is new issue market. This market contributes directly to the capital formation of a company, as the company directly goes to investors and uses the funds for the investment in machines, lands, buildings, equipments, and more. Second one is secondary market. A market in which the sale and purchase of newly issued securities and second-hand securities are made is known as a secondary market. In this market, a company does not directly issue its securities to the investors. Instead, the existing investors of the company sell the securities to the investors. The investor who wants to sell the securities and the one who wants to purchase meet each other in the secondary market and exchange the securities for cash with the help of an intermediary called a broker. What do you mean by depository? A depository refers to a place or entity that holds financial securities in a dematerialized form. A bank, organization, or any institution holding and assisting in security trading is referred to as a depository. Depository accounts holds securities in the same way that bank accounts holds funds. Buyback of shares. A share buyback is also known as a stock buyback or share repurchase. In simple terms, the purchase buyback meaning is a financial strategy adopted by companies to repurchase their outstanding shares from the market or existing shareholders. As unlikely as it may sound, this share buyback holds its own importance. What are the types of share buybacks? First one is tender offer. In a tender offer, a company extends an invitation to shareholders to sell a specific number of shares at a fixed price. Specific number of shareholders have the choice to either accept the current buyback of shares and sell their shares or retain them. Open market repurchase. Through an open market buyback, a company buybacks the shares gradually over time from the open market. The share prices may fluctuate depending on the prevailing market conditions. Dutch auction. Employing a Dutch auction company sets a price range and allows shareholders to submit bids indicating the price at which they are willing to sell their shares. The company then purchases the shares at the highest price that matches the market demand. In last one, direct negotiation. The least common type of buyback is direct negotiation, where a company engages in one on one negotiation with individual shareholders to repurchase their shares. Thank you.